The market loves a neat, linear narrative, and for the better part of the last 3 years, the consensus story written about Plug Power on financial television, retail subreddits, and mainstream terminal chatter has been one of unmitigated structural decline. Trading around the $2.30 level with a market capitalization hovering near $2.94 billion, the stock is viewed through the retrospective lens of its pandemic-era peak, a cautionary tale of overpromising, excessive capital expenditure, and a painful dilution cycle that left long-term bag holders nursing catastrophic losses. Yet this superficial consensus completely misses the hidden thermodynamic and operational reality unfolding beneath the surface of the company's Q2 2026 financial print. While retail traders on platforms like Robinhood and Webull look at negative net income and fixate on historical cash burn, institutional heavyweights like Renaissance Technologies and Handelsbank and Fonder have been quietly accumulating positions, recognizing that the company is undergoing one of the most violent gross margin inflections in industrial green tech history. To understand why the stock price action fails to reflect the underlying operational transformation, you have to look past the headline noise and examine the physics bottleneck of global industrial decarbonization. Modern logistics networks, massive warehouse distribution hubs run by giants like Amazon and Walmart, and heavy chemical processing facilities face an intractable energy density problem that lithium-ion batteries simply cannot solve. Batteries suffer from severe weight penalties, long charging downtime, and exponential efficiency drops under heavy material handling loads. Hydrogen fuel cells, conversely, provide continuous, uninterrupted power with zero degradation over multi-shift operations, but building a vertically integrated green hydrogen economy requires conquering staggering logistical, chemical, and cryogenic engineering hurdles. Plug Power spent the last several years absorbing the massive upfront capital costs of building out that foundational infrastructure, constructing domestic green hydrogen production facilities in Georgia, Tennessee, and Louisiana, scaling the manufacturing of GenDrive fuel cell systems, and deploying GenEco industrial electrolyzers across 5 continents. The market priced Plug as a failing speculative venture when it was actually operating as a heavy industrial engineering pioneer navigating the steepest part of the S-curve adoption model. Now, as gross margins pull out of negative territory to near break-even and operating expenses are slashed by roughly 50% year over year, the structural mispricing becomes glaringly apparent. Wall Street is valuing a nascent industrial monopoly using rear-view mirror metrics, while management quietly executes on an upgraded 2026 revenue guidance of 15 to 16% growth and a clear line of sight toward positive adjusted EBITDA by the fourth quarter. This fundamental disconnect between institutional accumulation and retail exhaustion plays out daily in the order books and derivatives markets, where high beta clean energy sentiment creates a churning pressure cooker of volatility. Daily trading volumes exhibit classic accumulation characteristics during consolidation phases, punctuated by sharp upside momentum candles whenever quarterly operational updates surprise consensus estimates, such as the recent second quarter report that topped revenue expectations by over 5% and drove a swift 6.4% post-earnings rally. Retail investors, conditioned by months of sideways chop and macro interest rate jitters, routinely get shaken out at local bottoms through stop-loss cascades or options decay, while sophisticated institutional capital steps in to absorb the float. The options market structure reveals this underlying tug-of-war vividly, with derivatives volume heavily skewed toward out-of-the-money calls, notably at the $2.50 strikes, outnumbering puts, indicating that smart money is positioning for a structural breakout once the broader market stops treating every green energy stock as a macro proxy for interest rate risk. Institutional players are not looking at yesterday's income statement. They're underwriting the multi-year replacement cycle of over 20,000 GenDrive units across Plug's core material handling customers, the scaling of recurring aftermarket service revenues that surged 82% year over year to nearly $30 million, and a non-dilutive asset monetization strategy designed to secure $275 million in liquidity without crushing existing shareholders. shareholders. Before we dive deeper into the mechanics of this operational turnaround and analyze the exact components of their hydrogen production network, let's pause right here. Are you currently holding a position in Plug Power through this multi-year transition, or are you sitting on the sidelines waiting for definitive confirmation of that fourth quarter EBITDA target before entering? Drop your thoughts, average costs, or strategy in the comments below, because understanding how other market participants view this setup is essential for navigating the high beta volatility ahead. To truly grasp where Plug Power is heading, one must completely strip away the outdated historical framing that categorizes the company as an old-school legacy alternative energy gimmick or a speculative pre-revenue startup. The business today operates as a deeply entrenched, multifaceted industrial hardware and energy infrastructure titan, anchored by three core operational pillars: material handling, green hydrogen generation, and industrial-scale electrolyzers. In the material handling segment, Plug is effectively the irreplaceable operational backbone for the world's most sophisticated supply chains. With over 76,000 Gen-Drive fuel cell systems and over 280 hydrogen-powered refueling sites deployed globally, the company powers fork trucks and automated guided vehicles for Fortune 100 fulfillment giants who cannot afford a single minute of warehouse downtime due to battery charging bottlenecks. This installed base creates a powerful high-margin annuity stream through recurring service contracts, equipment replacements, and hydrogen fuel supply agreements. The historical pain point for Plug was not a lack of demand in this segment, but rather the severe cost inversion of supplying liquid hydrogen during a period of acute supply chain disruptions, energy inflation, and plant startup delays. When third-party hydrogen suppliers faced crippling outages, Plug was forced to source merchant hydrogen at exorbitant spot market prices, dragging fuel gross margins down to deeply negative levels, reaching an eye-watering negative 91% just a year prior. However, the strategic pivot into vertical integration has completely altered this equation. By bringing online its own domestic green hydrogen production facilities in Georgia, Tennessee, and Louisiana, representing a combined nameplate capacity of approximately 40 tons per day, Plug has systematically removed external supply chain vulnerability. As plant utilization improves and logistics networks are optimized, fuel gross margins have staged a dramatic recovery, improving by nearly half to negative 48%, with every incremental ton of internal production lowering the cost structure further toward profitability. Simultaneously, the company's Gen Eco industrial electrolyzer business is scaling rapidly on a global stage, moving from a domestic novelty to an international juggernaut with active projects spanning 5 continents. From the 30-megawatt Barrow Green Hydrogen project in the United Kingdom for Carleton Power to the massive 275-megawatt Gen Eco feed scope on Hy2Gen's Corinth project in Quebec, Canada, and the landmark 50-megawatt electrolyzer order for Orica's Hunter Valley Hydrogen Hub in Australia, Plug is cementing its status as the premier technological gatekeeper for heavy industrial decarbonization. Looking out over the multi-year horizon, the catalysts driving Plug Power are shifting from speculative policy hopes to hard, locked-in commercial execution and regulatory mandates. In Europe, the strict implementation of the Renewable Energy Directive 3 framework is creating legally binding targets for heavy industries like steel, ammonia, and chemical refining to transition away from gray hydrogen derived from natural gas towards certified green hydrogen, making electrolyzer adoption an absolute existential necessity rather than a corporate ESG checkbox. Domestically, the phased rollout of clean hydrogen production tax credits under the Inflation Reduction Act provides a powerful economic tailwind, even amidst shifting regulatory interpretations, by anchoring long-term project economics for large-scale capital deployment. Furthermore, the capital expenditure cycles of mega-cap tech spenders and global energy conglomerates are increasingly intersecting with hydrogen infrastructure, particularly as data center operators and heavy industrial complexes look for reliable off-grid or localized clean power solutions to circumvent constrained electrical transmission grids.
Plug's ongoing execution of its non-dilutive financing initiatives, including capturing approximately $47 million over July and August out of a targeted $275 million asset monetization program, alongside the systematic release of restricted cash balances totaling over $155 million scheduled across the next 12 months, demonstrates a sophisticated approach to balance sheet management that directly defuses the existential cash burn bear thesis. While supply chain execution risks, project timing slippages, and macro interest rate volatility will inevitably continue to inject violent short-term price fluctuations into the stock, astute market participants understand that looking past near-term noise is the only way to capture asymmetric alpha in a foundational energy transition play. Plug Power has survived the brutal crucible of industrial scaling, transitioned its gross margins from catastrophic losses to the cusp of break-even, and positioned its operating expense run rate near a disciplined $75 million per quarter baseline. As the company executes on its upgraded 2026 revenue guidance and sprints toward its definitive